Welcome to day 3 of the Momentum Global Investment Management Think Tank Conference. My name is Ray Mary and I'll be your host again for the day. Today we have some amazing speakers from the US and the UK to close the conference, and we hope you really enjoy the content. Once again, don't forget, every session will be available to you in PDF format, and we really encourage you to use the chat box to engage with us and other delegates throughout the conference. Our first speaker for the day is Harvey from Momentum Global Investment Management in the UK. He is co-head of research and portfolio management, and he'll be talking about pandemics, portfolios, and potential.
Okay, thank you, Ray, and good morning, everyone. Great to talk to you today. I'm going to be talking about pandemics, portfolios, and potential. So, setting the scene a little bit, 6 months ago, I was out on my bike and we were in lockdown. And this was the scene on Oxford Street in the centre of London on a sunny Saturday afternoon, in the middle of the afternoon. And there's not a soul to be seen. It seemed unbelievable at the time as the world was in lockdown. But this was what we were facing at the time. We've all become very accustomed to it, but nonetheless, this was a seismic shift in everything that we had become accustomed to. And this is very much setting the scene for the pandemic part of this presentation, and trying to frame what we've been through before we put that in the context of our portfolios, the opportunities that we've had and taken, and the potential upside beyond that as well. The world was closing. Retail outlets had shut, restaurants were closed, we were leaving our offices and working from home. So it really was a seismic change in everything that we'd become accustomed to. Trying to put that in context over the last 100 years or so, when there's really been sort of 4 pandemics observable that we can look at in that time period. Starting with the Spanish flu just over 100 years ago. And looking at the performance of these 3, the Spanish flu, another flu outbreak in 1957, and then again in 1968, which was a mutation of the 57 flu just over 10 years later. The effect on performance in the US, relative terms, it was somewhat muted. We did have some drawdowns of sort of 10 to 15% or so. They are not necessarily comparable periods. They're very much idiosyncratic events. Markets and times were very different back then. Obviously, in 1918, there were other things going on as well. So we can't draw too much of a comparison with that. But you have to look at COVID-19 and the drawdown and the steepness of that drawdown, and the speed with which it took place, really to frame it. And what we can see there is the interconnectedness, I think, of markets, the speed of transfer of data in news flow, and the speed of the reaction to it. This was a scene that greeted people across the world, myself included, in my local supermarket. Shelves were bare. The pandemic was in town. But when we think about the performance of the market at that time, was it really about the pandemic, or was it really an investor reaction to the panic that ensued? A panic and a risk-off episode that we've seen at other times in markets across the world or in local markets. The pandemic and COVID-19 was the catalyst for it. But the sell-off was a reaction to a catalyst, and we've seen those type of events before. So I think it's important to frame it in that context as well. After the panic buying that we had in the supermarkets, at the same time there was sort of panic sell-offs in markets. And if we look here for the last 20 years or so, I've looked at the tech bubble and the bust in 2001. Financial crisis and COVID-19, and looking at how long it took for the market to lose 1/3 of its values in business days. During the the tech unwind, or the TMT unwind to be more precise, in 2001. It took well over a year for the market to fall 30% during the financial crisis. It was about a year in business days terms. In COVID-19, just about 22 trading days to lose a third of its value. So incredibly fast, incredibly rapid and steep. And as we know, the recovery has been equally sharp and perhaps surprising to some, given that we still sort of remain in the midst of a crisis. But this is really about a panic sell-off where the pandemic was the catalyst to it, but the reaction of it was so hard and fast, and that ultimately will present opportunities. And at first, there's very much this sort of denial, the expectation that perhaps it won't reach these shores. It was an Asian genesis for this pandemic, and perhaps, as we've seen with sort of previous viruses and epidemics, they might remain more localized. So there's this denial that it will get that bad, or that it will make it over here. And then, of course, that turns into fear, when, of course, it did in short order make it to our shores and across the world. And as Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. Well, very much that is where we were back in March. Markets were in free fall. Even US Treasuries could not find a floor before the Fed stepped in as a buyer of unlimited unlimited treasuries, and putting a backstop to the market at that time. And we framed this using a short-term risk indicator that we put together in-house a couple of years ago, and pushed back over history, just to help us frame the magnitude of risk aversion that we saw in the market at that time, and also, as we can see here, how that has retraced. Despite the world still being severely compromised, business activity is still very much compromised today, but market risk aversion has very much abated. And what you can see here is that the levels that we reached were only surpassed to those that we saw in the financial crisis, and they proved to be a very good buying point as well, as did the period immediately after the European crisis, particularly for European assets and European bonds, and also many sell-offs that we had, more isolated events in the US in the energy market in late 14, 15, and also a couple of episodes in 2018 as well. But just to frame it, this was a big risk-off event. And looking at the sentiment around forward-looking views of the post-COVID economy, this survey put together by McKinsey shows that across different countries, and it ranks, or it shows the proportion of respondents with an optimistic outlook on this sort of post-COVID economy, those who are unsure and those who are pessimistic. And in the right-hand cohort, you can see the European countries, and including the UK, and to a degree Brazil as well, very much making that up. But on the left-hand side, China is probably a standout because it was early in and early out. This was put together a little while ago, and perhaps India may not be so optimistic today because the problem certainly has got much worse there. But nonetheless, there's very different views in different countries about how we'll come out the other side, and that's really important in terms of the behavioural aspects around this post-COVID economy and any bounce that we may have. And then fear eventually turns into this fear of missing out, and that's somewhat where we are today. As Mr. Buffett also said, be fearful when others are greedy. At the moment, I could look at lots of stocks probably that have been inflated many times over in this recovery. There's quite a lot of retail money we're told following this. I could look at the number of sort of retail accounts opened since the start of the crisis as well. People at home opening online trading accounts and having a dabble. And you see that in Tesla, which is somewhat the poster child for this, and performance has been, off the scale. And despite a small pullback over the last 10 days, it's already recouped about 2/3 of those losses. And in terms of the forward price earning ratio, it's well into 3 figures now. So yes, the company is now making, successive positive earnings announcements. But at that kind of valuation, a lot has to come right to justify the valuation that we're at today, which as a market capitalization is the sum of several of the largest global car makers put together. So when we think about portfolios and the effects of what we've just seen, of that sell-off, the risk aversion, the potential opportunity that presents, and how we build our portfolios, we take lots of different ideas and put them in the portfolios together, where over time they can grow, and the trades and the opportunities that we're accessing can come to fruition. That is the idea, and we do that in a diversified, blended way. But you have to be dynamic, very much so with what we've just seen. We know the dramatic fall that we had through February and March, and then the Fed steps in. That was the final day, and after that, markets pretty much, certainly in the US, has been a one-way trade pretty much, and that's straight up. And it's really important that you are able to move your portfolio in order to access and benefit from the reversals that you see, and also taking the opportunity to build more diversification into your portfolios and rotate the shape of the portfolio as we go through time. So just looking at a couple of the ideas, a couple of the main ones that have played out, and things that we've tried to access and have accessed. I show you here just how the ETF, the credit ETF market became dislocated in March. LQD is the largest investment grade ETF in the world. It's a US investment grade ETF. And as March progressed, actually, the ETF traded a steep discount, almost down to 6% at one point, over 5%. And it persisted for a few days. And, that we just haven't seen that before. That's a major dislocation. It's one of the reasons, ultimately, that, the Fed stepped in after stating that they would buy unlimited amounts of treasuries. They also stepped in and said they'd be buying credit, and they'd also be buying ETFs. So there was a very much concerted effort to put a floor under this, and they did bounce back and briefly traded at premiums before normalizing again. But it just shows the fragility of the system, the need for liquidity as well, which when it's gone, it just dries up. It's either there or it's not. And in this case, it had gone away. And these discounts really, as spreads widen out and the liquidity dries up, for longer term investors like ourselves, that's an opportunity. On this red line, I show the emerging market ETF, and that moved to an even bigger discount, but again, over the same period. So credit was a theme for us. That was something that we stepped in at the beginning of April. We invested into largely crossover credit, which is the higher quality, high yield, and the lower rated investment grade. And a lot of investment grade strategies, may be required to sell bonds if they fall into junk, because there were bonds that were downgraded, issuers that become what's known as fallen angels. But crossover strategies can, make the most of that, the inefficiency across the rating spectrum between investment grade and high yield. So we felt that was a good way to access credit and access the added inefficiency of credits migrating between investment grade and what is known as junk, sub-investment grade. And I should add that actually, since then we've unwound perhaps 2/3 of that. It played out and retraced very quickly, and on several occasions we've taken that out of portfolios We still probably have about a third of that on today, but some of that has rotated. We've rotated that into ideas like convertibles, for example, which I show here. Convertibles won't be known to everyone, but what they are they are bonds with call options attached, essentially. And what happened through the first and second quarter of this year is that bonds, they became much cheaper. Sometimes the option was being given to you free when you bought it. Sometimes the convertibles were trading cheaper than just the equivalent straight bonds. So that looked attractive to us. We think they are great in multi-asset portfolios anyway. They give you what is termed convexity, which means that when the markets go up, you get more of that upside, and when markets go down, you get less of that. So we like that. It's a good attribute to have. But when convexity is cheap like that, and we saw that, this is a chart that we put together ourselves each month, and we can see there that probably half of the market was less than fair value, we should say, and about 30% of the market was probably more than 5% cheap, and very little was expensive. And that has retraced a little bit, but that's a trade that we put into the portfolios. We've added to it a couple of times actually since the nadir, since the bottom, and you can see how convertibles protected well on the way down. We did have owned convertibles through that period, but have added to it on the way back. And you can see pretty much it's been lockstep, one for one with global equities, which is fantastic performance from an asset class which has less than half the volatility of global equities. So that's exactly the kind of trade that we like to access in the portfolios, and a nice way to move the story away from the credit, but retain some upside to the growth, which had become a bit more expensive and arguably a little bit frothy, because convertibles are quite growthy in their nature, but being able to access it through convertibles rather than through arguably the slightly richer equities is a nice way to do it. I think the third example I want to show today, and one that we've moved quite meaningfully on, is actually in sort of real rates. What I show here is the 10-year US break-even, and what that implies is what the inflation rate is expected to be over the subsequent 10 years in the US market. And these fell off a cliff, whether it's the 2, 5-year, 30-year even, fell dramatically, with the 10-year US here falling to around 50 basis points. But there has been quite a sharp retracement, with nominal yields capped out and inflation's going higher. What that means is that the real yield has been falling very sharply, and it's now down in negative territory at around -1% in the US. And over the last few months, this again is a trade that we've been adding to since the bottom of the markets, when we saw break-evens right down at that low level. We didn't get on it straight away because the worries about inflation arguably are a little bit misplaced, or there is no expectation of rampant inflation soon. But as the message has changed, as stimulus has been added to economies, as the Fed has changed their message to one of average inflation over time, for example, there is an expectation that inflation could surprise to the upside. And actually, with yields where they are in nominal treasuries and bonds globally, they're not particularly attractive and don't add that much protection today. So for us, we've been moving some of the nominal duration exposure in our portfolios into real rates, where we think the profile and the payoff is a bit more attractive today. And of course, with real rates falling, another story there has to be gold, which has been a really important part of our portfolios in recent years, and particularly year to date. It's been one of the best performing asset classes. And with real rates falling, it's only pushed gold higher. So we welcome the diversifying qualities that has in our portfolios over the year, and still today. And talking of diversification, I look at this chart from Deutsche Bank. It's from their recent long-term asset return study called the Age of Disorder. And looking back almost over 150 years, they are looking at equity and bond valuations through time. And we can see that it has been somewhat cyclical, very much sort of mega cycles, really. But where we are today, with rates having fallen to such low levels, with levels we've not been to, this has helped propel equity prices higher, and particularly bond prices higher as well. So today, we are at or higher than perhaps the valuations that we've reached in the past. And that means that you've got to be diversified. You've got to have levers for diversification in your portfolio. And actually, just owning US Treasuries or government bonds probably isn't going to be enough with them at the lofty levels that they're at today. So just a refresher on how we diversify our portfolios. I know you probably won't be able to read all of the wording in there, but effectively we build our portfolios on this sort of concentric approach where we diversify at the asset class level with multi-asset investors, as well as sort of fixed income and equity, those core blocks. We include real assets, alternatives, gold. They are in portfolios. They're there for, that's the natural diversification. That's, if you like, the sort of free lunch that you get from multi-asset. But we do more than that. It's multi-strategy as well. You can break down each of those asset classes into different layers. And we access all of those through other underlying strategies, which is the second layer of diversification that we're building into portfolios. And finally, we're multi-manager, multi-strategy and multi-manager. And that's where you get the different styles that we pick up. And you can see that perhaps in the equity part, where we're blending together value, growth, and quality, or maybe in rates areas or credit, it's the short duration versus core duration, etc. That again adds another layer of diversification. And when you put them all together, you truly build a diverse multi-asset portfolio. A lot of those levers, some of them did fail to work as well as one might have hoped through the worst of the crisis, but when they fell, effectively diversification was on sale, and that's really when you want to be building it into your portfolios. And actually, in the ensuing months, most of them have recovered, and the diversified portfolio approach has been, a very strong way to move forward. So thinking about the potential and the upside, what is potential? It's that capacity to grow, to develop, to nurture, and to make gains. And it's generally something that's unrealized. It's going to take time to unlock, and it really sort of plays into several different themes. This is again from McKinsey piece that they put together. It sounds and looks, fairly self-explanatory. Digital entertainment, wellness, hygiene, nesting. Staying at home and improving your environment as you're spending more time there. But all of these themes are things that can be, accessed by the managers that we invest with. And this is the potential that they're trying to unlock. And potential goes beyond, just these themes and, stocks. It's also sort of potential in people, processes, working environments, etc. So there's potential to be had everywhere, and the human nature is to, adapt and move on. And just looking at a few stocks here, which sort of exemplify this actually. And I've picked a few across different industries. We've got Shopify and Mercado Libre, which is more sort of consumer and retail based. Etsy, which is hobbycraft. Chegg, which is online education. Adyen in payments. Teladoc. These are all stocks that most of which did fall a little bit, but have risen strongly out of the back of COVID. These are they're some of the clearest beneficiaries to the upside. So, potentially in all these names, and arguably these kind of themes, this is what we're looking to access in our in a number of our strategies, and we get our managers, our third-party managers, they have a role to play in portfolios in order to access these. So a quick word on our global equity fund, which is fully actively managed. We've constructed it so it's roughly half sort of fundamental active and roughly half systematic, the fundamental side being qualitative and fairly high conviction, and the systematic side being exposed to these well-recognized equity risk factors, and it's cheaper and systematically implemented. And those names that I looked at in the previous slide, they slot in. It's not quite as delineated as that, but generally they slip into that part of the growth momentum part of the portfolio. So we get access to those stories through our managers, and that's where we can share in that potential. And some of these names, names like Facebook, Apple, for example, even some of our value managers have owned these. Facebook, for example, the underappreciated value of Instagram, WhatsApp, for example, that is both of those owned by Facebook, can make that look attractive to a value manager, even though these are themes that will unlock in the future. Sustainability, very important as well. We believe that accessing sustainable themes, which pre-COVID was riding a wave, is really important. And we've got a solution now, the Global Enhanced Index Equity Fund, which is it's daily dealing. It's a low tracking error approach. It's managed by Robeco, and it's got an ESG integrated approach. And it's $350 million at the moment. Very good performance. That's since November 2004, using the Robeco strategy. Very pleasing. And the approach there, as it says, 20% better ESG scores than the world index, and a 20% reduction in the footprint across the four dimensions noted. So very exciting to have that out there as a tool in our box, and something that we can bring to our clients to access sustainable themes for the future, and really benefit from the potential that can be unlocked as companies become more attuned to the environmental, social and governance requirements that investors want. And unlocking that potential, as I show here, you need patience, and with patience comes time. And what we see here is a couple of return streams. This is going back to 1985. One is pretty volatile, one is a lot more stable, but they both have the same return. And the reason I show this, the reason I like to show it, is that actually they are the same return stream. This is global equities since 1985. But one of them is through a 1-year total return lens, and one is through a 10-year lens. So if you have the mindset of a long-term investor, your experience will be much less volatile. You're less likely to leave the show at the wrong time just before markets recover. So it's very important to have a long-term mindset. That's something we can do, and something that we build into our portfolios and our modeling, and provided investors and clients can share in that longer term mindset, then you can unlock the potential that is on the table at times like this. Just to finish up, and looking at US equities over a number of different epidemic episodes over the last 30 years or so, and looking at the performance of the S&P in the subsequent 6-month and 12-month periods from the months shown, you can see that actually the average upside has been pretty good. We expect markets to go up over time, so that is largely probably to be expected. And these are all idiosyncratic events, and it's hard to weave too much of a story between them. But the point is that with all of these, and some more notably, some of the bigger ones like SARS, for example, swine flu, both of those particularly sort of prevalent in Asia and pulling markets back, and certainly on news flow, they hit the headlines. Those were big risk-off events, and the ensuing sort of gains that we saw were pronounced. I put the numbers there for COVID-19. We've seen very strong returns since the end of February. In 12 months' time, it's yet to be seen where that will be. If history is anything to go by, then we would expect there'd be a good chance that those gains will be retained, if not exceeded. So I think there's a lot of reasons to be optimistic today. The world is changing, and we're reaching this sort of next normal, if not new normal. But people are, social animals. We want to be open for business and get back to some degree of normality, and people will adapt. And the sooner that we can get things open again properly, I think the world will, improve even more. And I shall finish up there. But it's been a pleasure talking to everyone today. If you have follow-up questions, etc., then please do get in touch. But for now, I will hand back to you, Ray. Thank you.